Company growth analysis. The primary driver of a company's valuation is its ability to grow earnings and eventually dividends. There are a number of ways that a company can increase its earnings over time. 1. Growing the business. Companies can increase sales by entering new markets, entering into partnerships and joint ventures, winning new contracts or customers, developing and launching new or improved products, improving marketing and sales offerings, and more. 2. Raising prices. During positive economic times, some companies gain the ability to charge higher prices for their products as demand increases. This is particularly significant for resource producers during bull markets for commodities. 3. Cost controls. A company can also improve its profitability by reducing expenses, although those that do run the risk of cutting corners. To measure this, investors often look at expenses such as administrative, sales and marketing, interest and depreciation as a percentage of sales to determine how efficiently management is running the business. Looking at operating earnings as a percent of sales, margin, can also give an indication of a company's profitability. Risk of disappointment. It's important for investors to recognize that while companies can enjoy great success, there are also numerous risks that could cause them to lose money or see businesses decline dramatically. Fear of negative outcomes can limit the upside potential for shares, or even cause declines. 1. Operating risks. There are many possible problems that a company may face as a part of normal business, including machinery breaking down, the entry of new competitors, price wars, input cost increases, adverse economic conditions, lost contracts or customers, and more. 2. Political risk. This varies by country but relates to the potential that a new government could gain power and implement adverse economic policies such as tax increases, new regulations, asset nationalizations, and other initiatives. 3. Currency risk. Companies operating in multiple countries run the risk that increases and decreases in currencies relative to each other could impact the company's revenues or cost structure and may increase or reduce the earnings power of foreign operations in terms of the home currency. 4. Legal risk. This relates to the possibility that the company could be sued. This particularly appears in sectors where there can be disputes over patents and intellectual property which could lead to significant damage awards or injunctions against doing business. 5. Insolvency risk. In difficult times, companies with high debt levels can find themselves unable to meet their obligations to have enough financing to meet their day-to-day obligations. To determine the financial strength of a company, there are a number of ratios that an investor can analyze. These include debt to equity equals total debt, total equity, measures how leveraged the company is, times interest earned equals operating income, interest payments, measures a company's ability to at least service the interest portion of its debt. Current ratio equals current assets, current liabilities, measures a company's ability to meet near-term obligations with current resources. Fundamental analysis or stocks. Another useful question for investors to ask is how the market is valuing the shares of a company relative to its peers. The reason for this is that more expensive shares tend to carry higher expectations and higher trading risks, while companies with low valuations and expectations carry the potential for upside surprises. Dividends. Dividends can also have a significant impact on market sentiment. While earnings can be dependent on accounting estimates, dividends represent a payment of actual cash to shareholders. Dividends have become an important component of shareholders' income and return expectations. Because some shareholders rely on dividends for income, companies that cut their dividends tend to see their shares punished severely by the marketplace, and those that eliminate them entirely tend to lose institutional shareholders who are restricted by policies that dictate they can only own dividend-paying shares. Because of this, companies tend to only raise dividends to levels that they feel confident they can maintain over the longer term. The dividend yield is calculated as dividend per share, price per share. Dividend coverage ratio equals earnings per share, dividends per share. Dividend coverage ratio equals earnings per share, dividends per share. This measures the company's ability to earn its current dividend. The higher the level, the stronger the potential for dividends to remain at their current level or increase, while a level below 1 suggests the potential for a cut. XD date. Another thing for share traders to consider is that once a dividend is declared, there is a cut-off date by which you must own the shares to receive the dividend.